Ever wondered how banks across the globe ensure they have enough capital to cover their risks? In today's financial world, this is a question of paramount importance, and the answer lies within a set of banking regulations known as the Basel Accords. The Basel Accords, named after the city of Basel in Switzerland where they were developed, are a series of 3 progressive regulatory standards: Basel I, Basel II, and Basel III. These standards are put forth by the Basel Committee on Banking Supervision, or BCBS. This committee is a global group of banking authorities who work together to provide a forum for regular cooperation on banking supervisory matters. The primary goal of the Basel Accords is to ensure that financial institutions around the world maintain enough capital to meet their obligations, even in the event of a financial crisis. By setting minimum capital standards, the Accords aim to reduce the risk that banks will become insolvent if they suffer significant losses. But it's not just about preventing bank failure. The Basel Accords also have a broader objective: to enhance financial stability worldwide. The Accords aim to make the international banking system more resilient and less prone to crises that can have damaging effects on the global economy. In essence, the Basel Accords provide a framework for banking supervision that is designed to promote the stability of the financial system. They do this by setting out detailed standards for how much capital banks need to hold, how they should manage their risks, and how they should operate in a transparent and accountable way. The Basel Accords are not a one-size-fits-all solution. Instead, they provide a flexible framework that can be adapted to the specific circumstances of individual countries and banks. This flexibility is crucial in a global banking system where financial institutions vary widely in size, complexity, and risk profile. Now that you understand the purpose of the Basel Accords, let's delve into the first accord, Basel I. This is where the journey of global banking supervision really began, setting the stage for a new era of financial stability. The story of the Basel Accords is a story of evolution, response, and key takeaways that continue to shape the world of finance today. In 1988, the first Basel Accord, known as Basel I, was introduced. This global regulatory framework was developed by the Basel Committee on Banking Supervision, with the aim of promoting stability in the international banking system. Basel I was the first attempt to establish a set of minimum capital requirements for banks, which, in essence, is a safety net, a buffer of sorts, to protect against potential losses. One of the key tenets of Basel I was the requirement for banks to hold capital equal to 8% of their risk-weighted assets. The idea was to ensure that banks had enough capital on hand to absorb a reasonable level of losses before becoming insolvent. It was a way to mitigate the risk of a bank failure, which could have severe economic implications. However, while the principle of requiring banks to hold a certain amount of capital was sound, Basel I was not without its criticisms. The main point of contention was its simplicity. Basel I used a fairly basic method to calculate risk-weighted assets, dividing them into different categories based on the type of asset. For instance, government bonds were considered risk-free, while corporate bonds were deemed risky. This simplicity was both a strength and a weakness. On one hand, it made the rules easy to understand and implement. On the other hand, it was seen as too simplistic, failing to accurately reflect the riskiness of different types of assets. It did not take into account the creditworthiness of the borrower or the likelihood of default. This meant that a loan to a financially stable corporation was treated the same as a loan to a struggling company, despite the obvious differences in risk. Another criticism was that Basel I did not consider off-balance sheet exposures, which could also pose significant risks. It was a one-size-fits-all approach which did not adequately capture the complexity and diversity of banking activities. While Basel I was a step in the right direction, it had its shortcomings, leading to the development of Basel II. In 2004, Basel II was introduced to address the shortcomings of Basel I. This heralded a new era in global banking regulations, an era where risk management was to be at the forefront. Basel II was built on a 3-pillar structure. The first pillar, minimum capital requirements, sought to ensure that banks held enough capital to cover unexpected losses. The idea was simple. If a bank lent money, it needed to have a safety net in place just in case. But unlike Basel I, which had a one-size-fits-all approach, Basel II allowed for more flexibility. Banks could use their own internal models to calculate the capital they needed to hold, reflecting the specific risks they faced. The second pillar, supervisory review, underscored the importance of oversight. This pillar emphasized the need for banks and regulators to work together to ensure that banks were not only meeting the minimum capital requirements, but also managing their risks effectively. Supervisors were encouraged to review and assess banks' internal capital adequacy procedures and strategies, promoting a culture of continuous improvement in risk management. Then came the third pillar: market discipline. This was all about transparency. Banks were required to disclose information about their risk profiles, capital adequacy, and risk management strategies. The idea was that market participants, armed with this information, would be better positioned to assess the soundness of banks. This, in turn, would encourage banks to maintain strong capital positions and risk management practices. The goal of Basel II was to better align regulatory capital requirements with the underlying risks in the banking sector. It aimed to strike a balance between financial stability and economic growth, and for a time it seemed to be working. But the financial crisis of 2008 exposed weaknesses in Basel II, necessitating further refinements. While Basel II was a significant step forward, it became clear that it wasn't enough. The world needed a new approach, one that would better safeguard the global financial system against future crises. In response to the financial crisis, Basel III was introduced in 2010. The financial world was still reeling from the fallout, and the Basel Committee on Banking Supervision knew they had to step up their game. They needed a more robust framework that could withstand financial shocks and protect the real economy from the ripple effects of the banking sector.